All right, what's good, y'all? It's your boy Tibby. Welcome back to the Day Trading Bootcamp. We're here with another one. Today, we're going to be talking about market structure and price action. Now, this is the good stuff, so make sure y'all take y'all pens, pads out, and make sure y'all are taking notes. Try to lock in and retain this information, but this is really the language of the markets. That's what I always love to say. Like, if you can understand this, you'll know you'll be set. You know what I mean? There's no strategy, no anything that I think that tops price action. So we're going to go ahead and dive into it. All right, so before indicators, before strategies, and all the extra stuff that people try to tell you to use to become profitable in trading, start with your market structure and price action. If you can read price action, you'll understand where smart money's positioned and where it's going next. All right. So why structure matters is because price moves in cycles, and if you can read those cycles, you'll understand where smart money is positioned and where it's going to next. This is how we identify our trends, reversals, and high probability entries. Okay, so there's three phases of price. We have accumulation, where price is consolidating and building orders, and then we have manipulation, which is pretty much a stop hunt or a liquidity sweep, and then the distribution or expansion, where price moves with direction and speed and its intended direction at that. All right. So we're going to go into examples of each of these, but we're just going to go and I want to talk about everything first. So the next thing you're going to want to understand about market structure and how it's built. Structure is built from swing highs and swing lows. So higher highs and higher lows equals a bullish trend. Then lower highs and lower lows equals a bearish trend. So when a higher or low gets broken, that's a break of structure. Okay. Now, the next thing we're going to talk about is change of character and market structure shifts. So when price fails to make a higher high or breaks a lower low instead, that's a change of character. That usually is a sign of an end of a trend or a start of a reversal. So a change of character tells me to stop looking for a continuation and start looking for the opposite side to start taking control. All right. So let's just go ahead and jump straight into some examples, and so you guys can get a better idea of what's going on. Okay. All right. So the first thing I want to talk about is going to be the three phases of prices. Like I told you, accumulation, manipulation, and distribution. A lot of times you'll see this like referred to as like AMDX, accumulation, manipulation, distribution, or expansion. And sometimes the X can mean like a reversal. So it just depends. Once you're at the end of that you sit tight, and there might be another accumulation phase, there might be another manipulation phase, like whatever. So that's what the X pretty much means. So to kind of give you guys a basic idea of all of these, a basic drawing of each of these, I'm going to go ahead and show you guys right here. So let's see. All right. So for accumulation, like I said, that's when price is consolidating. It's not really making any new highs or new lows, right? So accumulation is going to look something like this. So that's going to be your accumulation phase right there. All right. So with this drawn out now, so let's see. We're going to do, so for accumulation, this is going to be your accumulation phase right now. So this is just a basic drawing. Whenever you're looking at the charts, it's never going to look this perfect, but just trying to give you guys an understanding of what all of this means. Okay. So this is accumulation. Like I said, it's not making any new highs, no new lows. It's building orders to go in whichever intended direction that it wants to go. So after the accumulation phase, that's when you're going to look for the manipulation. So manipulation you would look for would be somewhere right here. Not somewhere right here. This is the manipulation in this drawing. So we have the accumulation, then we have the manipulation. The first move is usually the manipulation, trying to fake people out of their position, right? And also give smart money and the bigger funds an opportunity to get in at a better price. So that's what's going on right here. So we're going to mark that as the red. So that's for manipulation. That's what's going on. So we have the accumulation where it's building orders, and then we have the manipulation where smart money is going to get in. They're looking for this opportunity, and the larger funds are going to get into their position. And then after that, we're going to have our distribution phase. So that's from right here on up to however high it decides to go, right? So that's going to be the distribution phase. So like I said, this is going to be the accumulation. We're not making any highs, new lows. We're accumulating and building orders. That's what accumulation. And then we have our manipulation, where price is doing a stop hunt, taking out all these people who are in too early, right? So that they can have have positions available for the larger funds to get in down here during this manipulation. And what's causing this to move so fast and jump up so fast is because these larger funds that are able to move the markets are jumping in at this point. So this is like, all the retail traders are trying to get in or just getting chopped up in this area. Then boom, take out all these stops, large funds get in, then boom, we get the distribution or expansion in the real intended direction. So the same thing goes for the opposite way, right? So if we were looking for shorts, that's how we can look for longs. So if we were looking for shorts, we would, I'll draw that out for you guys too. So longs means you're buying, you want price to go up. Shorts means you're selling, you want price to go down. So again, like we have our accumulation right here. Then we would have our manipulation, and then we would have our distribution, right? So like I mentioned, we have our accumulation right here. Then we have our manipulation at the top end. And then boom, we have our distribution down to the sell side for shorts. So these are just basic examples, okay? So how you can kind of understand what you're looking for when this happens. The accumulation, again, building orders, people that are in too early. Then we have the manipulation where the market is stop hunting, taking out those orders from people that are in too early. Just getting liquidity, turning everybody into liquidity, and also giving smart money and the large funds an opportunity to get in during this manipulation leg. And then boom, we have our distribution where price goes in its intended direction. All right. So we're going to hop into the charts and I'm going to show you some examples. Now it's not going to be perfect because like the drawing looks perfect, but once we get into the charts, you kind of see that it's not perfect. But once you have the idea, you'll be able to spot these things. All right. All right. So let's go. I'll just try to show you guys something. So even right here, I mean, if you wanted to look at this like that, right? So all of this can be considered consolidation. So all of that right there can be considered solid consolidation. Then boom, we have our manipulation leg. And then we have our distribution where we go and take out all the liquidity that's resting above here, the buy side liquidity, right? So accumulation, chopping back and forth, building up orders. Then boom, we shoot down, make people think we're coming down here. Then we also take out all of this liquidity here. We get people on the wrong side. And then so the larger funds are getting in at this point again. And then boom, you see we go up in a short amount of time for the distribution phase. All right. Now I'm going to try and find another example for shorts. And so you can also understand that like there's no time frame, like it doesn't have to accumulate for a certain amount of time. It doesn't have to manipulate to a certain price point. It's just, I'm just trying to give you guys examples so you guys can see. So right here, we can view this as there's a couple right here, right? So we had accumulation on this small area right here. This is just as, it's not a huge move, but you just see it in action, right? So we have the accumulation, then boom, we have our manipulation. And then we have distribution, right? And like I said, it doesn't have to be a huge move, but you have to focus on the process and use your charts to use your take profit. So it's like, you would be targeting the opposite side of this once you get this manipulation, then boom, we sold off. And then even right here. So like, this is kind of like a good example of it not having to be, or there's no specific amount of points are supposed to go or anything like that. So like for this short, like you see this, after we had this distribution, we came back to accumulating again. Remember I told you the X can mean it goes back to accumulation, or it can be continuation. It can be a lot of different things. So now we have this, oh shit, hold on. So we have this accumulation phase right here. And then you can look at all of this as manipulation, right? And the thing is that once you understand this, you can make your moves on either side of the market. Like you can be in this manipulation leg if you understand that this is manipulation. You know what I mean? So just understanding that just puts you in a better position. And then after we had the accumulation right here, then we have our manipulation leg, and then boom, you see all of this is distribution. So let's try and zoom out. All of this is technically distribution right here. All right. So yeah, so you see we had accumulation, which even all of this could have been considered accumulation, right? So that's the thing about this is that in my previous videos, I told you about session and timing when you wanted to place your trades, right? So all of this could be considered accumulation, but this is during like the Asian session, right? So you can find trades during the Asian session, but the moves just aren't going to be as drastic. So you see we accumulated during this Asian session, like that started Monday or Sunday going into Monday. Then right when London opened, we had our manipulation leg, and then we had our distribution towards the end of the end of the London session. And then boom, we get accumulation for the remainder of that London session. Then New York opens. Then boom, we have our manipulation leg. And then for the PM from 11, or pretty much the close, or just 11 o'clock. I can't remember if this is in, let me see what time frame this is in. Yeah, this is all right, but yeah. So right here, we have the accumulation pre-market from London into the New York Open. And then even down here, you can even consider this a little bit of move right here, manipulation leg, which will let you know, because we have this, the way this wick down and swept the low, this could be a manipulation leg for this move up. But on the bigger picture, we have the consolidation, and then we have this huge manipulation leg up, and then we have the distribution after hours. So sometimes it'll happen after hours, but with you understanding how things work, you should have been able to get into this trade during the New York session, right? Because like I told you, you can find opportunities to trade during manipulation legs and during the distribution leg. You just really want to stay out of the accumulation. That's the main one you want to stay out of. All right. All right, perfect. So now let's go ahead and talk about, we want to talk about swing structures, okay? So like I told you before, structure is built from swing highs and swing lows. So it's going to be higher highs and higher lows means bullish, lower lows and lower highs means bearish. Bullish means price is going to go up, bearish means price is going down, simply put. All right. So I'm going to go ahead and draw some examples for y'all. All right. So what we want to focus on. So if we're looking at a bullish market, this is what we would see. So we already spoke about consolidation. So this is consolidation right here. Price is consolidating. It's not making any new highs or new lows. It's just kind of chopping back and forth. And then so when we're in a bearish market or bullish market where we want to see price go up, we want to see something like this. So this tells us that we're in a bearish market, a bullish market, okay? And why we're in a bullish market is because we're creating higher highs and higher lows, right? So first you see we come up, we create a high, then we create a low, but this low doesn't go lower than this low right here, right? So that's letting us know we're protected right there. We came and we swept some internal liquidity, and then we're going to expect price to go and take this previous high, and then boom. And then we go and make a new high, And then again, we get another pullback where we make a lower low. And then again, go to make a new high. So this is going to be the high. And then we make a higher low. Then we make a higher high. Then another higher low that doesn't sweep the previous low. And then we make a higher high. And then if we're expecting the trend to keep going, we would expect it to pull back, and then we'll make another higher low. And then boom, we're expecting it to go and take this higher high again. Okay. So that's pretty much, that's what we would consider a bullish trend. Okay. Now let's look at a bearish where price is going down. We're expecting price to sell off. All right. So say we're coming here, we're going to make a low, then we're going to make a lower high, then we're going to make a lower low, lower high, then a lower low. So again, like I explained to you before, so we had our low initially. Oh shit. We had our low initially right there. We had our low initially right here. So we had our regular low, and then we created a lower low, right? And then we come up and then we create a lower high, right? That's what this is. And then boom, after we do that, we go for that low that was previously created. We can expect price to go and sweep that low. Then we create another lower low. And then we're going to pull back and create a lower high, making sure that this previous high that was created is still intact. And then boom, push down again. And then we have a lower low again. And this is a bearish market, so we're expecting price to go down, right? And that's what that signifies right there. So a break of structure is pretty much just like whenever we create a new low or a new high. So like in this example, like, you know, we created a low, we came back, made a lower high, and then boom, when price comes back and takes this area out and comes down, that's a break of structure. That's what they call a break of structure. I can't write with that shit, but y'all understand what I'm saying. Break of structure. So yeah. All right. So again, let's go back and try and find some examples. Again, the drawing's always like a perfect example, but you know, we can see, I want to show you guys how it looks in the markets. So we'll probably go to like a 5 minutes so you guys can kind of see. So all of it, like this is all an upward trend, right? So you can tell that this was a bullish market. So if we started from right here, boom, we came up, we made a high, then we made a low, then boom, we made another high, then we come down, we make a higher low. So we don't come down and sweep the previous low. We get close, but we don't sweep it technically, right? So after that, we go and take out the high and make a higher high. And boom, we come back, we make another low. And then right here, so this is where some people could get, you know, you could get tricked out in thinking that price isn't going to go up any higher, but you know, that's why you just sit and watch what happens. So this is a failed swing high right here. So another way you could look at this is like a change of character. So it's like a short-term change of character. So it might be, this is when things like this happen, you'll look to see if price is going through a reversal, or this will let you know that the trend is stopping for short term. At least it might go into consolidation before expanding again. But I think that's enough for you guys to kind of understand the lower low, lower highs. Y'all see how it plays out. And then boom, we make a higher high right there. Then we come back, make a lower low or higher low. Then we make a higher high. And then right here, we go into consolidation where we come and we're just like bouncing back and forth. Technically, we're not really making too many new highs or new lows. So I mean, that's a simple way to kind of look at it. We did come down, you know, it came down, swept this low, and then we took that high. But all in all, that's pretty much consolidation. I mean, you would look at that as consolidation. I wouldn't want to be involved in this type of price action right here, but this is what I want to be in. I want to be in all of this where it's moving up, we're making high. I wouldn't want to be right here, but I wouldn't be there anyways, because this is pre-market. This is before the market opens. And then boom, this is market open right here. We see we get the push up, we get a pullback. We don't create a new low. Push up, we don't create a new low. So I can expect price to continue up. All right. And then same goes for whenever we're looking at shorts. This will just be a quick one, but you can see from here, We come down, make a low, make a lower high, and boom, we go make a low, lower high, low, lower high, low. And then boom, you see we have a market structure shift right here, technically, where we come back. We don't go and take out the lower low to show that the trend is continuing. We fail to take out that low. So that lets us know, okay, we should be looking for a reversal. Price probably wants to start going and seeking liquidity on the opposite side, which it does. So that previous example was the bullish, was pretty much the reversal of what I'm showing you right now. And then we reversed and went up at higher highs and higher lows. All right. Okay, so the key takeaways from this lesson right here is that, structure is king. You want to use higher highs, higher lows, or lower highs and lower lows to define the trend. You want to watch for break of structure to confirm your momentum, and you want to use change of character to catch early reversals. You always want to zoom out to see the bigger picture and then zoom in for precision. All right, but all in all, I mean, hey, that's pretty much it for this one. Like I said, take the notes. I hope some of that sinks in. We'll get into the next episode. This is where we'll especially be able to talk about liquidity and how to spot it and how not to be the liquidity. Because if you don't know where it's at, you're probably the liquidity that the market is seeking and taking you out for the bigger funds and smart money to get in and continue their move up. But yeah, man, if you found this helpful and it clarified a little bit, just go ahead and hit that like button for your boy, hit subscribe. So, we're just getting started. Next episode, we're going to be diving into liquidity. That's pretty much how the market hunts stop losses and how you can trade with smart money instead of against it. And if you want to see me trade structure live every day, check out the premium community link in the description and check out your boy going live in the mornings. And yeah, we out.